Hello, this is Somitra and today we will have a look at what is known as Harami in candlestick charts. Before we jump into the discussions, subscribe for the channel and press the bell icon so that you get notifications whenever there is a new video. Also remember to click to like the video if find the content useful. The harami is comprised of a long real body and a small real body within its range. The harami is the reverse of an engulfing line. Whereas in an engulfing pattern there is a long candle engulfing the previous real body, a harami is an unusually long real body followed by a very small real body. After a downtrend, the emergence of a harami shows, as expressed in Japan, that the decline is exhausting ifself. A harami, after an advance, shows that the market must have failed to maintain higher prices. Either candle of the harami can be white or black, all combinations are called harami. However, after a downtrend, a white-black, meaning the first candle is white and the second is black, or a white-white harami is viewed more bullishly than a black-white or a black-black harami. This is because a long white candle is by itself viewed as bullish, so its appearance in a harami increases the chance that the falling power of the market will come to an end. The same rationale applies to a harami after an uptrend. A harami with a long black real body can be viewed as more bearish than a harami in an uptrend that has a long white real body. This is because a long black real body after a rally is construed as bearish, so when it is the first part of the harami pattern, the degree of pessimism is increased. If the second real body is in the middle of the trading range of the first real body, if, after a rally, the second real body of the harami is near the upper end of the first real body, the odds increase that the markets will consolidate rather than reverse. It is referred to harami as a high-price harami since the second session's price is in the upper end of the prior range. In a downtrend, if there is a harami with the second small real body near the bottom end of the trading range of the prior long real body, then the outlook is more likely for a market lull rather than for a price reversal. It is called harami pattern, a low-priced harami. If the entire range, that is, the open, high, low and close, are within the prior real body, the chances increase for a price reversal. The smaller the shadows and the shorter the real body of the second candle, the better the signal. If the second candle is a doji instead of a small real body, it increases the probability of a reversal. This combination of a long candle followed by a doji in the first candle's real body is called a harami cross. Some Japanese literature refers to harami as transition periods in the market. This means that if a harami in an uptrend is exceeded, it is viewed as a bullish continuation signal. If the price closes under the low of the harami session in a downtrend, then expect more selling pressure. This image illustrates how a rally that started with November's bullish engulfing pattern hesitated at a harami in December. This harami had two aspects that increased its reliability. The second day's small real body was almost in the middle of the first real body, and the entire range of the second session including the shadows was within the real body of the first session. It is interesting how the same scenario unfolded in February. Again, a rally began from a bullish engulfing pattern, and then again stalled with a classic harami. With the harami, as the Japanese would say, a crack has entered the market. A shooting star a few sessions after the February harami was also a bearish upthrust in which the market made a new high, but the bulls failed to hold these highs. Although the shooting star session had a real body within the prior long white candle, these two candles did not form a harami because the upper shadow of the shooting star was too far outside the prior session's range. If there was any doubt about the serious trouble this market was in, the falling gap at the arrow should have been the final proof. Note how the harami sessions in December and February became ceiling. The low in this market was made via a hammer in April. Later that month, a violently long white real body was immediately followed by a diminutive real body. This formed a harami that precipitated a decline until the emergence of another hammer. In this chart, the sell-off from a bearish engulfing pattern found a foundation with May's harami. This second candle of the harami hovered near the bottom of the prior long black real body. As a result, there was more likelihood that prices would move sideways near the lower end of the tall black candle's real body. Note that the long lower shadows after this harami reflected healthy buying interest as price go near $80. The pattern marked X was not a harami because the white real body was not unusually long. For a harami, the first real body has to be very long relative to the preceding bodies. Another harami appeared in early August, but after an initial setback, prices exceeded the harami, so the trend resumed higher. This chart shows two examples of harami in which the open, high, low and close of the second real body are within the first real body. The October harami pattern was more important because of the extremely short real body. Its small size made it like doji session. Thus, October's harami could be viewed as a harami cross. This series of three long black real bodies labeled 1, 2 and 3 following October's harami underscored the inherent weakness of the market. In this chart, in February 1992, we see how a support area which included a hammer formed within a $19 to $19.50 area. Based on the axiom that old support becomes resistance, the change of polarity principle, we would expect $19 to $19.50 resistance area materialized in May. At that time, a harami pattern was followed by a dark cloud cover. Another failed attack at the resistance in late May occurred via long upper shadow candle. This candle was not a shooting star because it did not appear after a rally. As discussed before, the ideal harami pattern has the second session's real body in the middle part of the first candle. However, if during an uptrend the second candle hovers near the top of the prior candle, that is a high-price harami, the chances increase for a consolidation rather than a price reversal. Here, we see how several high-price harami marked 1 through 3 developed from early June through late July. After each of these, the market consolidated for at least a week before moving out of the trading range. This chart brings out another use of a high-price harami or a low-price harami in a downtrend. Option traders can consider selling volatility. This is because after a high-price harami in an uptrend or a low-price harami in a downtrend, a trader could expect that the market porcher may temporarily settle into a lateral band from a previously strong trend. This could mean a decline in volatility.